Hello guys, how are you? How's everyone doing? Chat is open. Feel free to do all the questions. Rev, how are you? What's going on, my friend? Feel free to, see how was your day today. If you have any troubles today. 5 o'clock. What's up, Empanada? Good, man. Sharp, as usual. We got to respect the times, right? Let's wait 5 minutes until we have more people coming in. And how was your trading day today, guys? How do you like today's price action? What are your expectations for tomorrow? First profits today, Johnny. Congrats. What did you trade, Johnny?
It's difficult for the citizenry to feel safe when we can't.
Buy? Beautiful.
Wow.
Nice. Yeah, Spies was. I will show my charts afterwards, and I'll show what we did today and how we can use the implied volatility, the IV, and what happened today. That was really good. It was interesting. We came back exactly where we started yesterday. So we had a huge move yesterday. Even though we have good data, we gave it all back. And we'll see what the PPI is going to bring tomorrow. See what's going to happen. Yeah, SPX puts Gail. Beautiful. Congrats, Gail. Gail has been killing it with SPX lately. Awesome. Yeah. Who else do we have here? Johnny, Turco, Viral. How are you, Viral? I have you with your name, correct name.
Yeah, it's viral. All good.
Thank you.
Yeah. UPS trail, it's looking very interesting for next week.
When the clock is ticking, this is my expiration.
Let's hope the earning would go good too.
Yeah, I like it. And what about that FTX? FedEx was money.
Yeah, but now it's way up, so it can go down anytime. FedEx is volatile sometimes.
Yeah, I got out of that trade. I thought it was the move that I wanted to do was already in, and I went just small, so that was a fun one.
Me, I was fucked it on.
Yeah, it paid me well. I mean, the whole year, that's the biggest gain I have.
Yeah, that was fun. That was a lot of fun. IWM today was crazy too, guys. IWM in the pre-market and then kept going up, and it's still going up in the aftermarket. I'm gonna keep my eye on IWM tomorrow. We had a great day today. We traded SPX, we traded Apple, we traded Tesla. That was pretty good in the morning.
Look at the Baba. Baba is doing so well this week. It's keep going up.
We tell ourselves.
Yeah, I'm looking Baba right now. It's I always do those gap ups on the
You know what they said?
on the pre-markets.
Israel turned against themselves and they killed each other in their night. Look at all the blood, and it was the sun shining.
It's very nice. It's also with TSM. If you see TSM, TSM is very interesting.
Look what he says.
TSM
And they
is
said, "This
always
is blood." And the kings have surely struck swords and have killed one another.
Would you put this guy?
I muted, yeah, Diana and Colin already. Yep, no worries. Yeah, TSM, if you see TSM the last days, TSM every time it closes and then it gaps up in the pre-market, closes and it gaps up in the market. Let's see today if it closes, and it should gap up all the way to 188 today. Let's see how it opens tomorrow. I'm interested to see how that is gonna go. All right, guys, I think we have 20 people here. I'm gonna start Canadian dollar futures now. What, Amar? Nice. That's you don't rest. All right, guys, let's start with this implied volatility. This is not the most exciting sort of subject to do lectures with, because it's a lot of more definitions and a lot of theory, but we will go and see later on the options chart how do we choose our contracts based on implied volatility, how do they work, and how that's gonna help us decide which contracts are we gonna basically select. So I have to start with the basics. I'm gonna just start with the basic definition, so we know when every time that we talk about IV, be careful with the IV, be careful with theta, be careful that it's got your IV depending on the market. When most of you probably have seen the trades that Flips does at the end of the day with SPX. Those trades that we do at the end of the day is just a huge shot of IV that those SPX contracts received just in the last 10 minutes. So what it's tricky is that you can choose those contracts to be at a price of $60, and then all of a sudden you see the volume coming in and that IV absorbing all that volume that it's coming in towards, and you see how the price just raises, and then we go from 60 to 300, 400, $600. That's implied volatility, the IV coming into those contracts plus the volume making those like a sponge. Is the same size of a sponge, like the ones that we use to clean the plates and everything, but all of a sudden it just inflates, it soaks all that kind of IV, and then in one candle, it just can squeeze everything out. So that's why you have to be very, very careful. So the implied volatility is the market's forecast of a likely movement in an asset's price. So we're gonna talk about that historical versus implied volatility. Implied volatility is just a way that we have to calculate the future move or the future volatility of a certain underlying price or underlying name. So that's how we use it. It's normally represented in a percentage price or in a percentage number. And they have a couple of different ways to show. And we'll go through that when we go to the option chains. How do we get the implied volatility? It's a derivation from the price of the options and a reflection of the market's view of the likelihood of changes in a given security price. Remember, we are just trying to calculate what's going to happen in the future price of that specific ticker or name. The difference between the implied volatility and the historical volatility is that historical volatility is based on the past market price fluctuations. And I will show you that there is a way on how to see that on TOS. I don't know about TradingView or Webull, but TOS has a way that you can choose how to see your implied volatility versus your historical volatility, and you can change the prices. And there's like two charts that they kind of like tangle together and they cross each other like the EMAs. I don't use it on the chart. I go to the percentages on the chain and the options chain. But I would love to show you that, you can do some visualizing on how it works and how that relates to the actual price of the tickers that we trade daily. Why IV is so important, and why do we talk so much about IV? I mean, remember, how do we choose a contract? Or how do we choose a future trade? Sometimes we go to the open interest, we go to the volume, and then we have IV. So it's gonna depend on the IV, and that's gonna help us choose which direction based on this formula price is gonna go, and that's gonna make us choose like if we are deciding to go long, or are we just gonna shorten a certain price specifically. So this is some of the differences that we have between the lows and the highs of the IV. Like, how do we have the features and expectations of the low versus the high implied volatility? So how do we have the market expectation of a low IV? Well, when we have a low IV, that means that we have low volatility. The price action is going to be very low. It's going to be very steady. So if you're looking for a steady price action, and maybe you're getting in a longer term position, having a low IV is not necessarily bad. It's just going to show you that it's not going to be very volatile. Then, of course, the comparison is going to be high IV. You're going to have a significant price movement.
I was just talking to McKenna right now. I got to take these tickets, go sell them right now.
So if you're looking to go into a position that, maybe you have a very you're looking for a big difference and a big movement in the price, a high IV can be your go-to. But if you're looking maybe for something to be very conservative, and you just want to have that position on the longer term, a low IV is not that bad. So remember, depends on what your objective is on the specific trade or investment that you want to do. The market sentiment, it could be on the low IV, it's going to be bullish or sideways. Normally, it's not going to be that bearish. But on the high IV, it can be bearish and reactive. We will see this in a chart, and we will see how this works and why this is this way. How do we have a risk perception of a low IV? It's a lower risk environment. That's why I said it's good for certain longer time investments, or for if you want to just day trade certain things. But normally, when we are day trading, we are looking for volatility. So we're looking for high IV. We look higher risk environments. We want to see pumps and moves on those on the price action. Hi, Lena. Hi, Marina. Welcome. Welcome, everyone. Thanks for joining in and sharing with us. Remember, guys, any questions that you have at any time, you can just put it on the chat. Normally, all of you are unmuted, but if anyone is, left the microphone on and is not paying attention or anything, I will mute you, but you can always unmute yourself just to have everyone here. The premiums on the low IV are always going to be less expensive, and the high IVs, because they are more in demand, are going to be more expensive. And how do we differentiate the potential trading opportunities on the low IV versus the high IV? Well, there are certain strategies that we use that is going to be beneficial for the low IV. So we have the iron condors, we have the cover calls, and some spreads that are going to be better for having low IV. But the high IV, when we do strategies like the straddles and the strangles, that we're looking for big moves in the upside or in the downside, are going to be benefit of the higher IV contracts. So we have to choose and decide this, and it's going to depend on what specifics are we looking to do on a specific investment or a day trade. Ethan, what are the terms sideways and reactive? Sideways is that when we don't have a aggressive move going up or down. Sometimes if we're trading on a range, there are certain, like sometimes you can trade on a a straddle, and the straddle, if you don't have any specific volatile move, it's not gonna work. But if you have an iron condor, and for an iron condor, the stability is a lot better for those sort of tactics that we use on specific options techniques that you can use to protect you on the up and the downside. We'll talk about IV crush. Yeah, we'll talk about how that and that comes with the time of the contract. Some of the pros and cons of using the IV. It quantifies the market sentiment uncertainty. That's the pro. We have set the option prices and then determines the trading strategy. Some of the cons that we have is it's just based solely in price and not in fundamentals. So we don't go through the whole fundamentals of the company. It's just a price measure. And we have to consider, and I talk about this a little later, implied volatility has its faults. It doesn't include search. It's just we'll discuss about how it goes into the European options versus the American model of options. I don't know if you have heard about that, but when the mathematicians and economists invented the options, actually the first invented were the European options, and the European options were based that every time that certain formulas were based on those, you imply that the contracts will always go to expiration. You were not able to sell those contracts ahead or before the expiring time. But they changed the name or they have this other product called the American option that the American market invented. And the American options, the ones that we traded every day and we trade, we have this advantage that we can sell them whenever we want. And that's why we do day trading with those. And we have the benefit of using, less money with a better exposure of 100 shares. And then we can just actually gain on the premium gains and then just get rid of the contracts. European or the regional or European options, you were not able to sell them. Once you got into the contract, you needed to wait all the time until expiration. So the mathematicians and economists that invented the implied volatility, sort of the IV formula, did not get that completely into the formula. So there is a little change there that you have to we got to be careful. And this is how it's calculated. It's called the Black-Scholes model. It's a formula that it's calculated by multiplying the stock price by the cumulative standard normal probability distribution function. So thereafter, the net present value of the strike price that we're trying to get is going to be multiplied by the cumulative standard normal distribution that is subtracted from the resulting value. So yeah, it's a mathematical formula that we don't, if you want to go more into depth, we can go into the numbers and everything. Normally, we don't need to calculate it. It's just done in all of our brokerages apps. They just have it there and we don't need to do anything, but sometimes it's just nice to see how it works and what the faults are. Do the option makers make dollars out of the premiums? What happens to that? To the makers? They make money out of all the contracts that they make. They make a percentage out of everything that they make, and that's how they make money out of it. They have a specific sort of percentage of everything that they move, but we'll go into that a little later. Hawkinson, yeah. Factors affecting implied volatility. Well, we have the market sentiment. We have, of course, if it's bullish or bearish outlook, it's going to change how the IV is going to be affected. We have the supply and the demand for options. The volume that we have, it's going to change how it's go. We have any upcoming events, it's going to change the IV. If we have, we're expecting Apple to do great with the future phone, the future iPhone 16s that they're going to have AI or whatever we are speculating that they're going to have, those contracts are going to be moved and the IV is going to be moved. Like these days that we have, for example, SPY, we have QQQ, and we have economic data releases like today and tomorrow. Those certain contracts are, even though the SPX are going to be pumped. Let's say they're juiced. That's how they call it in the slang. Every time that you hear that we said, oh, those contracts are juiced, look at that, look at the prices. That's also the IV getting pumped because people, it's getting demand of those contracts because they expect that those contracts are going to hit. So the more demand we have for a contract, the higher the IV is going to be. And then we call them, streetwise Jews. They're Jews, those contracts. So, and then of course geopolitical events. So one thing and one way how they see how the volatility works, and we're gonna go through the I will go to the chain option chains to see this. They call it smiles and skews, and I'm gonna try to do a to not to chart, but to show you this on the options chart and why they call it this way, because they look like if you have like a little smile or a little skew to one side or to the other. So the volatility smile is just when the IV tends to be higher for deep in the money and then higher and deep out of the money option. So they go to a high IV to a high IV, but then we do like a curve. And we go in the middle of that curve, we go to a lower IB, and then it goes again to that deep out of the money, it goes high again. So we will see these in the option charts. And then the volatility skew, it's when we have asymmetry on the IV across the strike prices. So that means that if we are at the money or high in the money, it's gonna be like one little smile. But then if we are very out of the money, it's gonna be a straight. It's gonna be like a swoosh, for like a Nike swoosh. It's gonna go from one side just straight to the other one. It's not gonna be like a little nice sort of smile or a semicircle. And this is how this is the Black-Scholes formula. If any one of you wanted to see it, this is what it represents. This is the call option price, and this is how it's calculated. I'm not gonna go into the depth of the mathematical formula because it's great to see how it's done, but we have the advantage that all our trading platforms, they do it for us. So just wanted to have it there. This is what a volatility smile is. It's the graphical representation of the IV plotted against a strike price for the options. And that's why we're going to see that curve. So the curve looks like a smile, hence the names. Then what are the characteristics of this volatility smile? Why do we care about it? Well, the IV, it's higher on the deep end of the money and on the out of the money, but it's really on the options on very out of the money. And then if this phenomenon occurs because traders expect more extreme movements in the ordinary lines asset price that can affect the likelihood of the options being exercised. So we have to be careful when we are deep in the money, because they are getting close to, if you don't roll them over, you're going to get closer to be exercised, or if you are too far away out of the money, then they're going to be lost and you're going to lose your premium completely. So there's more demand for higher premiums and then higher IV because of that. And the current market price is going to compensate this for the risk. And this is how that looks. The volatility increases as the option becomes increasingly in the money or out of the money. This is how that chart is going to look. This is our implied volatility going up. This is our strike price increasing. This is at the money, so we're neutral. And the more in the money the puts we have, we're going to have a higher IV, and then out of the money calls are going to have higher V. And then here we have the same with the out of the money puts and then in the money calls. So we switch because we have in the money puts, in the money calls, and then vice versa with the other side. And it looks like this. So let me show you. I'm just gonna get out of here and I'm gonna go through this here. So now you can see my charts here, and here is look, this is TSM, for example. And here I have my implied volatility. And you see how when this is my chain of options, and look how this is deep in the money calls. Look at how the implied volatility here, it's 147%. And then it goes down, it goes down, it goes down, and it keeps going a little down, down, down. It tries to go higher, but not really high, you see? Goes all the way to 50%. But so we go from 147, 50, 49, 49, and then tries to climb up, but the climb up is not really high. It's just like a little, if you see it's gonna be like a little chart like this. It's not really like a curve. It's like high and straight down. And same in this name. This name is high and then straight down, not really doing anything. But sometimes when we go to other names, like for example, SPY, look at SPY out of the money, it puts 700% implied volatility, 700%, 600%. Then it goes all the way down on implied volatility to when we are at the money, 30%. And then when we go again in the money, deep in the money, 1,000% here. So you see, this is like a smile. The smile is not going to be like this. It's like sideways. But I think you get the idea how it goes from, look, 1,000% in at the money, 95, 62%. And then all the way, look how it goes all the way to 600, 700, 800%. It's huge. But then this is puts. But look at the calls in the money. All these calls, they have nothing, no implied volatility, nothing, just in the money, 8%, and then it goes all the way to 600. So it goes from high to sort of like a flat line here. So this is very interesting when we're deciding like how much, like how much percentage of move I'm expecting to have on this contract. But then we have the probability of being out of the money is 99%. So thus we have this huge percentages. So this is really nice to see. But then, as I said, every name will have, like, let's see Tesla, for example. If we go to Tesla, then Tesla has deep in the money, 17, then it goes higher with the more the money is. So we expect having higher moves toward these more expensive prices. And then in the money, I don't have that, there's not as much interest because it's very flat. There's not going to be much volatility. But then look at the puts. Puts very far out of the money at 75, 140%. And again, they go down 59%. And then look, deep in the money, outside of the money, they don't, when we are too high, like far away out of the money, flat, nothing. Because these 400s or whatever are just too outside of the price that we have. So it's very interesting when we want to decide on how to use it. I'm not in love all the time with the implied volatility. I use it, I like it, but in my style of trading, normally I'll go more to volume and open interest. And what I do have in my charts is this little implied volatility set here. You see, I know that my implied volatility is 91%. So I know what's happening. And then this is a chart that I wanted to, or sort of a graph that I wanted to show you. In TOS, we do have the opportunity to mix historical volatility versus implied volatility. So we can see how the historical volatility is very high, like, you know, it's been very high on these price actions here. And then look at here, it's lower and it started increasing, whilst we were going up implied volatility, all of a sudden went up. And then today that we have this huge flush on Tesla, look how we crossed again towards the normal volatility, the historical volatility, and we cross it here. If you want to know how to get this chart, if you go to your studies and you go to historical volatility and then imp volatility, you can put both of them in one chart and it's going to show like this. Because if not, it's going to show one like this and the other one like this. It's going to be like separated. So it's easier when you have them both together. You see, it's going to have, one is going to be like in another chart. So I just put them together here and I put my, where is my implied volatility here? Historical volatility. I just added to my implied volatility little lower square, and now they're mixed here. That's a way to use it. I don't, let me see if I can increase the volume of my 1 second.
Hey, I just joined. Are you talking about Tesla? Like, is it good for a dip buy or something?
No, I'm talking about Tesla just because I'm talking about how the here the volume it's better here. I'm talking about Tesla just because I'm showing how the volatility works here, not a specific Tesla. I was showing Tesla when we have the percentages of implied volatility. When we go here, I wanted to show how when you are deep in the money, percentages of the implied volatility are very high, and then they go lower, 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 the more out of the money you are. The more out of the money you are here, implied volatility on the puts, it's lower, 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 and the more out of the money that you are, they increase it here. So every time that you have a lot of volatility possibilities, the IV is going to be a lot higher, and then the more, remember, the more you are in the money, the less risk you have. So there is less implied volatility. So this is very cool to see. I just wanted to show you guys that how can you have this in your chart if you wanted to use this as an indicator. You can always see, like, when there is turns like this, when you see this breaking up, this is supposed to be a call indication or a positive indication, and then when it breaks down, it kind of, this is why you see that how the volatility all of a sudden just dropped, and we have this cross here. So
Hey, I got a question.
yes.
Okay, so I'm here trying to understand something about how to choose my contracts.
Okay.
And okay, so let's say I have my list is open, and usually I
Here.
go for the in the money, or yes, exactly. Either I'm in the money or maybe $1 or the next one out of the money that where I'm expecting. Let's say calls here.
Here.
Okay, which
You-
here we go. Great. So now, is there any magic number that we need to see at the money? Because I see this one is at 143.92. What does that mean? Does that mean it's very good contract because it's more than 100%? Is there any key or rule of thumb to a number, or compared to the other strikes, or we can compare this to the other strikes? How can we use the percentage to our advantage? That's the question.
Well, when you have to see this, that's a great question. Thank you. Like, to compare these, what you're gonna do is, normally when you are at the money, the percentage that what you're looking at here is that you're gonna have a lot of volatility. This is a lot of volatility either way, but this is the lowest, like sort of the lowest volatility that you have. Like, this is the lowest number is 112, and then 143. So these contracts are very sought after. Doesn't mean that this is the perfect contract to get in, because everything's gonna depend. This is weeklies, and normally at the money are the most sought after. So they have a little higher implied volatility most of the time there. And these, which they're, look at the spreads on this: 70 to 12, 107 to 16. Even even though the percentage is not that bad, it's not as good, because there's no, or for example, in my opinion, I don't use implied volatility as the only way to choose what contracts I'm using. So just trying to find a magic percentage number to choose it, I don't have it. I don't use it that way. No, I just try to see where am I compare with the other contracts, and how much volatility I'm wishing to have in my contracts compared to the other price actions, to the other prices. Because one thing that they discovered is that the price action, the volatility was not linear, that each of these contracts, depending on, also it's going to depend on the implied volatility and on the open interest and the volume, are going to have different price actions, and that's why we have different percentages. So that's why the formula, it's a little bit, it's just missing just these tiny things. But it's not that I will choose depending on what price, on what I'm looking at. But I will look more, as I said, I don't use it that much. I rather myself, even though we're talking about this, I look for my open interest. I look for a bigger open interest with more volume, because this way I know that I have more liquidity which is different. I on the contracts that I get in and out pretty fast, I'm looking for how many people have these contracts and how fast I can get rid of them if I just want to day trade or scalp. So normally my go-to setup will be volume and open interest. But there is no a magic percentage number that it's going to help you choose which one is the best contract to choose. This is just a guide on how much volatility are you expecting to have in that contract, and how and what are you looking at. So remember, if you choose something from here that it has 176, it has more volatility, because this, if we have some crazy move and we go to 300 on Tesla, it can go all the way here. So that's, that's why it's bigger. And here on this side, it's lower because the expectations of these moves here might not be right now as far, because this is what's happening right now. Look at this. The puts and everything are going higher, higher, and higher because we are going low. And with the move that we had today, these things just got crazy. So also when these ones start, moving a lot higher, we are losing a little more interest on the call. So everything is going to move in a balance. So I hope that can explain a little bit, but there's no magic number and percentage. It's not like when you're looking at a specific gamma or vega number, like everything above 0.3 or below 0.3 is like what's best, because that's the rule of thumb. No, I know, or at least know that I use it, or know that I know. If anyone knows better than that, please feel free to add to the lecture, but I don't use it that way.
I mean, I appreciate it. Thank you. That was I was looking for something like different, but correct me if I'm wrong. What I'm choosing right now is completely different. I've never used IV before. All I use is in the money volume of how many contracts, which you just mentioned, and the price, and of course the price of the contract, because that affects how many contracts that I'm going to buy based on my cap. That's pretty much what I'm going to use.
You
Exactly.
will go to volume, and here you don't use open interest at all when you choose your contracts?
Not really. I use volume, and I use the price of the contract. I try to go to as close as to the money as I can if I can afford it, basically. Or it's based on the next move. If I have my levels on the chart, let's say $2 move to the upside, and I see that I'm gonna be in the money at the end of the move, at the end of the $2 move, and that will increase my delta and the rest of them, and how many I'm gonna cut off before I'm going to hit my level. Those kind of things that I'm looking at. Correct me if I'm wrong. And if you don't mind, please, can you just briefly explain, let's say this is the chain of the options that you have in front of you, and we are now day trading live. What is the best contract that you're going to choose for a $2 to $3 move, basically? Thank you so much.
Yeah, thank you. Listen, there are many factors that depend here. Normally, I always like to go one after the one at the money. I always go one lower than at the money. Normally, I like to go between this one here or this one here, because I like the volatility to pump and get me in the money. And then once you're in the money, you don't have as much volatility. So sometimes when you choose some of these contracts that are a little bit far away from in the money, you get the advantage of this volatility here. So if I want to get that volatility going and get me through in the money, I'll choose one or two out of the money. But I don't go too far away unless I do have maybe a bigger, like for example, if I go to open interest and I'm playing Tesla, but I'm not playing weeklies. I'm playing October 18. And I don't want to pay $3,000 for a contract, but I do want to participate on a higher move. I can go a little far away in the money, but my first way of choosing it is going to be my implied volatility and my volume, my open interest and my volume. So I'm going to look for somewhere here. Quiet. I need to have the most liquid contract that I can have for my investment. So if I want to do the move that I want and it goes $4 in the money, and I jump from 1,200 to 1,800, I can just get rid of it. I don't care. You know, maybe those $600 was my goal and that's it. But that's the way. But if you see, if we compare this with our IV right now, and we see the IV that we have on the 300s, look at the implied volatility on this, it's fairly low. Why? The more time we buy in a contract, what this is telling me is it's good. The price volatility that I'm gonna have, it's gonna be very mild. That's why sometimes we look to buy, you know, certain percentage out of the money, and we buy time. The main goal of buying time is I'm not gonna, if I buy Tesla like today, and I was in some puts, I don't remember which ones, and I got them somewhere, I think the 250s, they went from, I don't know, $150 to $400 in one move. It was huge how they went from, you know, from 0 to $1,000 or something. That's a huge move, and that percentage here, they were somewhere around here, and that percentage went up. But then once they got in the money, you see how the implied volatility just fades. Why? Because there's no, every time that you get in the money, either in calls or in puts, you don't gonna have any moves. Like there's not gonna be radical. That's why you're safe when you're in the money. But the more time that we try to buy, you see, look at this. This is 21 of March 2025. Look at the implied volatility. It's very, very even, because I have so much time that the contracts are not going to be that risky, are going to be more expensive, but the move are going to be more control. So that's why sometimes we like to buy more time. And but that will be the main difference. I think that what you're doing with Delta, and one of the things what we are doing, and somebody mentioned the Ivy crush. What happened to the Ivy crush is if I buy a contract that it's too far away out of the money, and this move doesn't happen, my IV, my percentage here is going to crush my price action, and it's never going to reach. So the volatility is going to be faded away, and the move never, the contract never is going to pump that volume that it needs to kind of move. It's just going to fade on that 145% chances of, you know, not doing anything. So that's how I see it. And that's one of the, that's why you use it, and how it's the way to use it for the shorter time frame and then for the longer time frame too.
Is it possible to check for one contract? For example, since we are on Tesla, July 26th, I see open interest for 265 calls, around 3,600, whereas 367, I see like 1,200 open interest. 262.5, I see 740 open interest. So whichever has more open interest, you recommend to go for like more open interest ones, is
Yes,
it?
I always my let me
Would that
see.
have an impact on IV with more open? What does open interest mean? Like, is it people have already got
Yes,
that?
open interest is the amount of contracts that are open at that specific time. This number here, 19,000.
Could you repeat?
15,000 and 19,000 of the open interest means the amount of contracts that are open right now of that specific price. So this means that people are right now holding that contract. They are open and they're not exercised. And the volume is the amount of contracts of this price that were traded today. So every time that I choose a contract, I like it to have a bigger and a higher open interest and a higher volume. That way I can get in and out of the contract pretty fast. If I cannot get in and out pretty fast, it doesn't work for me. So this one here, look, 134,000 and then 15,000. This contract is great if you're looking to get in and out and see if the move it's gonna go your way. This doesn't mean that you're gonna get the price action here. To decide if this is the way we need to go, because all of these people can be wrong. You need to choose what the price action is telling you. And for example, this is my chart today on Tesla, and this is why I was charting Tesla today, and this is why I decided to jump into Tesla today. It jumped here, it broke my I had this little price action charted like this. It broke my level and my trend line from the pre-market, and it went down, 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 and I got these candles here and I sold here. And since I'm looking at my Bollinger Bands, you see how my Bollinger Band, it broke up above. This is an entry indicator, then another entry indicator, and then it broke down and it hold down my what's it called, my B1. I was talking Bollinger Bands. So it broke, it hold my Bollinger Band and then on my BWAP and flushed. And every time that you see it then going away from your Bollinger Band, here's where you get out. If you get in again into the range, you get out, and then it kept flushing, but this is the move that I wanted to have. This is the move that I really, really wanted to have. So yeah, that's one way to see it. So let's go. I'm gonna go back to the presentation, and then we can go back to this different ones. You're watching.
I do got one question for you.
Yes.
And I apologize for interrupting, but for open interest, what would be a number 2 low when you're looking at a contract?
What would be a number 2 low?
Yeah, like for open interest, like what's the number that you look for when you enter the contract? Like, is 5,000 a good entry, or is 2,000 too low?
Well, remember what I was saying right now is that it depends on what the price. I mean, the open interest is just going to tell you how many people are holding that. Like, look at this.
Right.
This 275 weekly contract on Tesla. There are 40,000 people that they have it on open, and they're holding this contract, and then it traded 106,000 times today. But I don't see why you would like to get into this contract. I think people were holding this contract and they were not expecting the flush that happened. So it could be tricky, because even though this might look, interesting, these could be people that they leave the contracts open and they never sold at the time that they needed to sell. And then we have the huge flush. Maybe they were expecting this move to continue here, and they don't have a stop loss, and they just kept holding it. And then we got this flush, and they're trying to see if they're going to roll it for next week, or if tomorrow, if PPI is good, see if we have maybe a B bounce and try to go somewhere around 253, 248 and that. So you got to be careful with that. Even though this looks very interesting, might not be your best contract, because remember, you cannot only choose a contract because of this. You also have to see what's happening in your price action, and you have to see which direction you're going. So for me, it's not a matter of what will be too low. It has to match what the price action is doing, your levels, these levels, and what's happening with the candles. So for me, I will not grab anything on Tesla tomorrow below 250 for me.
Thank you, Bossman.
If I'm in Tesla and I want to grab calls, I won't grab anything below 250. And if I'm in puts, if I'm in puts with the move that happened today, I can go until here at 225. That they will be. But look at this one. Look at this is as much. How many people still holding these contracts right now? 20,000 and the move today on these contracts was 123,000. So these were huge contracts. Look at this. Look at this huge contract.
Could you read that contract? It is too small.
Sorry?
Could you tell what is that contract? It is too small to see.
If I can and put it this bigger.
She said, I think AI can't respond.
No, I cannot. Can you explain rolling contracts? Or what do you...
These are the 230 contracts he's talking about with 123 volume.
Yeah, sorry, I cannot put it a little bit larger. 230 here.
Okay.
I know there is a way that I can increase the numbers here, but I think it's in my setup, application settings. I think in display decimal places. I think order notifications. There was a way that I can move the numbers a little bigger, but I don't see it right now. Sorry about that. I'm gonna go back to the presentation, then we go back to the contracts, guys. Thank you, Matt. Can you explain rolling contracts? AJ, we'll do that in a second. We go back to the rolling contracts. Let me go here. Stop sharing this one. Share this one. So this is what's next. What's the impact? Let me just grab here. The impact of the pricing on IV options. It's gonna be the relationship we have between IV and the option premiums. As we were looking at the percentages, remember that we're talking about IV. Sorry that we went a little bit outside of of the topic, talking about open interest, but that's my favorite way to choosing contracts. The higher IV leads to a higher premium, as we saw on the options chain, and then the lower IV is same, inverse, lower premium. How the IV changes and that how affects our prices, Vega, where Vega measures the option sensitivity to changes on IV. That's one of our Greeks, and you have them also on the option chains when you want to decide what contracts you want to choose. And an increase on the IV increases the price on both calls and puts, while it decreases the IV on the lower their prices. So this is just how sorry, we inversely see or saw how these contracts were moving up and down depending on the percentage. We have some trading strategies that we can use for how to leverage the high V, so selling options. We can also remember we can use when we go back to the chain of options, we can sell calls or puts if we are on a position, and if we are in a position, we can trade against that position, and we can choose some contracts with higher volatility to choose the moves that we're expecting to have on those contracts. So that's a way on how we can see it. Let me.
What's always on top won't be on bottom at some point. So
let's see what we have here. Nick, you're muted. Then the importance of monitoring our IV during earnings seasons and other major events. Well, the earnings normally lead to spikes on IV. So remember, every time that we see a news or a comment of Elon Musk or Powell tomorrow, we're gonna see the IVs pumping and jumping all around on different names. Say QQQ, say Apple, anything that, even the banks are gonna be moving around, because banks are gonna be either, if he talks about any number that it's positive for banks to keep more money in it, banks are gonna move up. And tomorrow we have banks earnings on the pre-market. So tomorrow is gonna be a mix of a lot of information that we gotta be very careful at trading in the morning, because it's gonna be saying how the banks are gonna be affected by whatever the PPI is gonna say. And then we're gonna have whatever Powell is gonna say and the information from that data. So we gotta be careful. And every time when we see those events happening, we can see how the IV is gonna be jumping up and down. And why do we care about this at the bottom line? You wanna have a lot of volatility on the contracts that you're trading or not? You want something that it's kind of, buy some time, and that's gonna be a low IV, and you're gonna be steady and not, worried about what's gonna happen. Or if you're gonna buy same days tomorrow, SPX, you're gonna see the IV of that thing going up and down crazy. So that's gonna depend on what your expectation of that investment is gonna be. What are you expecting to do? I want to day trade, I want to scalp, I want to swing. What are you gonna do? Normally, if we're scalping, we want that volatility, we want that volume to come in because we want to do those moves that happen like today on Tesla. We want to jump in, see a huge flush or a huge pump, and then get out. That's it. Remember, we don't care about doing the whole move. No one's gonna do the whole move, the 100% from one point to the other one. We care about the best section of that move. And that's why we can choose those contracts with, more volatility, and that's why we care about IV. The software platforms today, they provide the IV, so we don't care about that anymore right now. How do we manage our IV? We have hedging strategies. We diversify our position sizing. So depending on if we are in a position at Apple long position, let's say that you have 100 shares of Apple, you can manage your IV environment if you see that shares are going up and down. Today Apple went down like 5 points, and then it went up again from 226 to 228, 2 more points. So and we don't know what's going to happen tomorrow. We can hedge with some options depending on that IV, those positions, and then we can protect ourselves normally on the downside. And normally on the downside, the IV is going to be higher because the moves go a little more aggressive normally. How our decision-making process is going to work when we are buying or selling options with IV? Well, we have to analyze our IV levels relatively to our historical averages. And that's when it comes handy, our historical volatility versus our implied volatility, because we want to try to compare if historically, if it moves like this, our volatility was the same or not. And that's what our chart that I showed in the TOS, it's going to show. So we can try to match that two lanes, indicators going the same way, or when they cross very aggressively, well, it's not going your way. You have to make a decision if that's what you were expecting, or if you need to cut that position or add more. Some of the pitfalls that we have on how to avoid, well, we have to overtrading high IV environments can be very risky because that can lead us to trade on contracts that they might not go in the money because we are too far away from it, because we are expecting such a huge move that if it doesn't happen, well, that we are not going to have that the expectancy that we had on that move and the gains that and the profits that we were looking for. And then we can always misinterpret the IV signals. We were maybe reading, percentages for a IV that it was just for same days, and we were trying to trade for a longer trade, and the percentages are not going to go our way. So we got to be very careful on how do we choose them. But as I said, for me, I look at it, but I make my decisions on open interest and volume, and I go into my IV I have my IV indicator just to know how volatile is that current ticker or that current contract. And this is just an example, quick little example. So we can have a little bit, not only what we saw on the chain of options, but how imagine that you have a stock that is trading at $100. And if you are at the money, your strike price is going to be 100 because we are at the money. So typically, this is going to be the lowest IV, and it's considered the most likely to be near the current price action at expiration. 100 is going to be, lowest IV. If we are deep in the money, and let's say that our strike price is 50, we're going to have a higher IV, because there is a higher risk of significant price movement affecting my intrinsic value. So deep in the money option is gonna have a higher IV. But then if I'm deep out of the money and my strike price is 150, that higher IV had the potential for a dramatic price shift, making these options very valuable. Why? Because I don't know if the price action is going to be, all the way to 150 and I'm gonna make a lot of money, or if that thing is gonna stay at 100 or maybe at 50 and it's not gonna do anything. So it's very interesting to see, and the best way, I don't love these examples. I like to see it more in the chain of options. And sorry guys that this is not, these topics are not the most exciting to do lectures with, because it's very theoretical. And I invite you to go to paper trade on either of your platforms and see how your implied volatility works for some contracts, and just take 1 hour every day, jump, get out of the market, go into paper trade and play around with, some techniques, do straddles, do sell options, buy options. Remember, I always like to go to the same example that you don't see guys playing, I'm gonna go for soccer because I like soccer. You don't see him playing the Champions League or the, I don't know, European Cup. And you don't, there's no a new guy that doesn't know what to do and just jump into one of those games. That guy, it's been training for a whole year, trying to get an opportunity to go to the live game or that exposure to one of those games. One of the problems that we have as a traders is, since we have accessibility to the trading platforms and we have $1,000 in our account, we just grab the $1,000 and we jump into the live market, believing that we are going to score the first goal right away. Sometimes, most of the times, we have traders luck. Our first week, our first trades are always green. They're nice. We get excited. And then we get excited, we get comfortable, and we start losing all that money and more. And then we have panic, then we go down, and we start being all worried and depressed, and we never think of it as, did I practice enough? Did I was exposed to this type of move enough? Did I know how to use and how that specific contract that I choose, and why did I choose how that contract worked? Did I know? Did you have the practice? Like if you're a guitar player and they're not gonna put you right away in a concert. So every time for a swing first, only I enter, feel comfortable, learn a lot about it. Yeah, paper trade, viral, it's key. I like paper trade a lot, even during, I just step out of my normal day. I just open my paper trade and I start playing around. I start playing around with what is a straddle? What if I buy a call and sell a call, same price? What happens? How it moves? What if I buy a call and sell a put? What happens? What if I sell a put? What's a naked call or a naked put? I have no clue. Let me see how it works. And I just stay there. I sell a put of Tesla and I see if the price action going up, it's the price action going down. Oh, look at that. It's going up. It's I gotta be careful not to get exercise. Perfect. I encourage you guys to go and practice. Don't try to go straight up to the live market and try to buy $1,000 SPX because people is making money out of it. You need to have to feel confident. You need to know why you're buying, when you're buying, and you need to know what you're doing. I'm gonna share. I have an experience that I had no clue what margin was when I was an investor for a long time, and I just was saving money. And I started playing like day trading. And I had no clue what margin was and how it worked the way I thought. And at the end of the time, the market went down and I was deep in debt with margin because I had no clue what I was doing. And I learned the hard way. So this is just an example of how, I just want you to avoid doing mistakes while you're trading, just because we can just go straight to the market and try to bet if we can make $1,000. Don't do that. Be careful, be comfortable trading a certain technique, go tomorrow, get an hour and see how the IV works in contracts that you can choose. Do I like the IV? This is, and remember, we're talking about IV because it's just general knowledge, and these are tools that we use. But it can be not the tool that you like to use. Doesn't mean that you need to. As I said, I like to use open interest, and I like to use something different, and that works perfectly for me. And I don't like to have overcrowded charts. I don't like to have 10 different EMAs and my levels and volume. I don't like that. I like simple, nice. As you see, I'm very color oriented, and I need to react fast. Do that. Viral, it's sharing with us that he started at a different strike in the paper trading the money out of the money, different IV percentage, and he learned how the contracts move. The best way to learn and to choose your contracts based on your risk. And that's, thank for adding Viral. One thing that it's different for everyone, guys, is our risk exposure. If I have a $10,000 port, I buy at the money contracts of Tesla, 10 contracts of Tesla at the money, it's not going to be the same that if you buy, sorry, if you buy, if you have a $1,000 contract or port, that $1,000 port is not going to do the same that I can do. So we got to be very careful on how are we going to do our exposure, and how are we going to be doing our trade. So I encourage you to go and practice, do paper trade. Do not try to jump in anything right away because you think that, you know, you can just go into it. Please feel free to, if you have any questions. Thank you for your participation here. I know this is a very, you know, tricky subject, but we need to learn, we need to read. This is not, we need more time to be more focused on how implied volatility works and be able to do more examples. It will be great to have a live class when the market is open and we can see the moves and we can actually see how that moves. But we'll try to do that one day to see if everyone will be willing to do 1 hour of live trading just to see how markets work, and we can do paper trade live all together, and that will be fun. So we can try, you know, what if we grab this? What if we do this? And it's not gonna affect your positions. Let's see if maybe for next week or something like that, I can grab 1 hour and I can open one class and paper trade, and we all can do something different, you know. Let's see, what if we do samples. What if we go to Tesla and let's sell calls? What happened if we sell this call? Then we sell it, then we buy it back. Then what happened if we do a straddle, how the straddle works? And then, would you like that? You would like to do that, some interaction like that? Yes, I see some positive feedback so far. Nice. That will be fun. Let's see if we can try to do that. Yeah, next week, and we can all try to do a live session on how the contracts work on paper trade. Everyone on paper trade, and we can play around a little and learn what we're doing. That sounds great. Yeah. Thank you, guys. Next time you have a probability analysis chart on TOS that it does sort of a curve with percentages. You can go to it. It's on the Analyze tab on TOS. You have a simulated trade and you have a probability analysis. If you go to that probability analysis, that's a very interesting charts that you can see your contracts being. So try to play around with that. If not, we will try to go to that live lecture and we'll do that. And let's see if I can do it next week on Wednesday or something like that. And we take an hour or 2 hours and we go to that. Okay. I will call it on my tab. Thank you, guys. And please, if you have any doubts about the lecture, I know this one is very boring and tricky, but it's some things that we need to learn, and they are concepts that we need to read, and we need to go through them, and we need to know how they work. So if you have any doubts, questions, or anything, DM me, please. Always feel free to DM me any doubts that you have. And thank you for the company during the night. Have a great night.